Good afternoon, everybody.
Good.
Welcome to today's live event. This is Andrew Wilkinson with Interactive Brokers, and I am joined today for a session with ISS EVA. EVA stands for Economic Value Added. I'm delighted to have with me Gavin Thompson, who's the Global Director of Research at ISS Stocks EVA, and Casey Lee, the Global Director of Quantitative Research. Welcome to you both, gentlemen. Thanks for joining me.
Thank you for having us.
So, Gavin, will you give us a quick overview of today's session, what the audience can expect and what they're going to learn? I think we've lost Gavin for a second. Are you there, Gavin?
Yep, very much. Thank you, Andrew, for the invite. And sorry, I've had to turn my camera off. Would you believe it? In the UK, we're actually having a hot day today, and of course, technology doesn't like heat. Yes, can you hear me okay?
We can.
Can you hear me?
Yes.
Can you hear me now? Yes.
Yes.
Sorry, I was saying I had to turn my camera off because we're having a hot day. We're having a hot day in the UK, and would you believe it, technology doesn't seem to like heat. But thank you, everyone, for joining today's call. We're from ISS Stocks EVA, and today we're going to cover what we call EVA 101, along with the investor use case. So what we want to do is give you the insight into how to analyze a sector, industry, or stock using the EVA framework, and ultimately breaking down how to interpret the fundamentals of a business through the EVA lens and what market expectations for value creation or destruction are telling us. Before we dive into the presentation, I'll just give a quick little intro from my side, and Casey, who's on the call with me, will give a quick intro from his side. So as Andrew said, I'm Global Director of Fundamental Research here at ISS EVA. I've worked for ISS Stocks for 6 years, but prior to that, I was actually working for a large British pension fund as an equity portfolio manager. For 15 plus years, so had lots of buy-side experience before moving over to what we call the non-traditional sell side. So we're not a traditional broker. What we're doing is using the EVA framework to come up with our recommendations. I'll let Casey intro himself, and then we'll dive into the presentation.
Thanks, Gavin, and thank you, Andrew. My name is Casey Lee. I've been with ISS EVA since they acquired the firm I worked for previously, EVA Dimensions, in 2018. Before that, I'd been with EVA Dimensions for about 6 years. And before that, I worked for a competitor of ours, actually, and for about 10 or 12 years. Used to be based on the East Coast. I'm now on the West Coast. I do all of our back testing here, any of the quantitative research, generate screens that might be interesting to our clients. And I also cover the financials, healthcare, and communication services sectors. So we write up weekly reports that Gavin will talk about later. Gavin, I'll go back to you for the EVA basics.
Great, thank you, Casey. So economic value added, EVA, it's not new. It's been around since the 1990s as a concept, where it was originally used by the C-suite, so CEOs, CFOs, making those performance target setting, investment and allocation decisions. And it was actually 2006 or around 2006 that the investor use case was founded. And the platform, the coverage was expanded from that 2006 to then 2018, which was quite a significant year for us because the business was acquired by ISS. And over the past 6 years, we've continued to invest with the business, and under ISS, so Institutional Shareholder Services, it's given us the ability to also have some ESG, environmental social governance touch points. So within the research, actually, sometimes you'll see that we cross-reference financial materiality with ESG, which is becoming an even bigger concept. But basically, it's given EVA an even bigger footprint. So we're really pleased with that relationship. So EVA, we think about the world from an economic profitability perspective, not just from an accounting profit perspective. What does that mean? We know in traditional accounting there are many potential accounting distortions, right? You've heard about sort of gaming the system, inflating profits or deflating profits, different tax adjustments, etc. So what we're doing with the EVA adjustments that we're making to the as reported financials, of which there are around 24 conceptual adjustments. We're not saying we make 24 adjustments to every company, but we're looking at every company and whether we need to make those adjustments. And the output of that is allowing investors to make that apple to apple comparison, right? And we know in traditional accounting, that's super hard. So in our framework, you can compare Apple, the US tech giant, with Scania, the Swedish truck manufacturer. So it doesn't matter what accounting or region the companies are from, we're making that standardized level analysis that investors can then do stock picking from. So ultimately, we like to see if a company is lucky, good, or plain bad. And we're going to come on to some charts looking at the EVA drivers, the EVA fundamentals, looking at those business models to see how they actually are operating in the real world. Some of the key points on the right-hand side, you'll see superior to traditional measures of profit. Well, I've already mentioned some of those points, but the adjustments we're making is also combined with a capital adjustment or taking into consideration the cost of capital or a capital charge. And that consideration, the sources and uses of capital, we're building in a hurdle rate for the business. Yeah, so something that all investors should really demand to see if a firm is economically profitable, not just profitable on paper. The EVA framework's fully transparent. We don't have any black box ways of analysis, and that allows regional, country, cross-sector industry comparisons. The framework's style agnostic. What does that mean? It means that we're not biased towards growth or value. So the framework works equally well across the two different styles. We consider the future, so leading indicators in the form of the stream of EVA generation required to back out today's market value. And we think about fundamentals and investor expectations about the future as well. Now, not on commission for book sales, but there's also some good bedtime reading with that book you see in the top hand corner called EVA Best Practice. That is actually a very insightful book, which is, I'm sure, available through all good bookstores. And then the last thing on this slide is the extensive coverage we have. We have over 29,000 firms covered, so 29,000 public equities covered. So all regions, all geographies, all market cap. Page forward, please. So the ways we work with investors and how investors use the EVA framework for investment decision making. We have a global client base. We have some of the largest asset managers. We have some of the small wealth managers, and through our expanded relationship with ibkr, that's further widened our investor audiences as well. And we have a dedicated platform which we call Investor Express, which our institutional clients subscribe to, but they also receive the same research that's on the Interactive Brokers platform. How is EVA additive to the investment process? Really, it's sort of three main areas. We work on screening and idea generation. That's sort of working to narrow a large investable universe. This also feeds a lot of the research work that mine and Casey's teams are doing on a weekly basis. Single stock analysis. This is understanding the EVA fundamentals to see what's driving economic profitability, and the level of market expectations for future value creation. Again, this is also sort of feeding into the research that we're producing. And then the last thing is portfolio analysis. We offer portfolio analysis services, which looks at the positioning of a portfolio versus a benchmark and the underlying EVA exposure of the portfolio. Okay, next slide, please. So what is EVA from a calculation perspective? So simply NOPAT deducting a capital charge. So NOPAT standing for net operating profit after tax. That is taking into account the financial adjustments that we're making to give you that cleaned up NOPAT. And then the capital charge, which I'd say sort of is key to understanding the significance of EVA. I mentioned it in the opening slide. But that hurdle rate or the amount a firm must earn to cover its interest expenses after tax, leaving that net income level, providing shareholders with a minimum return on their investment, right? So think of that as the opportunity cost for you as the investor and really should be the minimum acceptable return. The capital portion is the total sum of debt and equity in the business. And then the cost of capital, we calculate the cost of equity using a capital asset pricing model, and then we calculate the cost of debt using or modeling bond yields. You'll see also that we have two calculations for EVA fundamentals. We're going to come on to that in the next couple of slides. So, but just to show that EVA margin, that's our profitability indicator, that's EVA divided by sales, and then EVA momentum, that's our growth indicator, and that's the change in EVA divided by sales. Okay, next slide, please. So understanding the EVA framework, we like to start with what we call EVA drivers. So these are the three levers that the management have in their control to direct the future of their business. So it covers sales, margins, and turns, which is our version of return on equity DuPont analysis for those that studied ROE DuPont analysis in the past. So if we think about sales growth, that's the gray shaded area on this chart, and it's on a trading 4-quarter basis. We think about things on a rolling annual basis, thinking about that long-term picture. And then the second line to look at is that blue dotted line, which is what we call EBITDA margin. And I stress that R because we all know EBITDA, but EBITDA is really reflecting the accounting adjustments that we're making to come up with that cleaned up P&L, that cleaned up profit and loss view. So EVA, in those adjustments, we're assuming all assets are owned, even those that are rented. And again, that's referring to that R, so you think of rent. And R&D is another of the big add backs that we make to the as reported EBITDA. So rent and R&D being two of those big adjustments that we're making. In traditional finance, these are being expensed. What we do is capitalize, which we think is super important, particularly when looking at R&D. So by capitalizing over a window, normally it's a 5-year window, then we are giving management the benefit of the doubt for making that investment. So the same way as if they would be investing in traditional CapEx, we can give management that view to making investment decisions for the long term. And it's interesting, IFRS in particular, the accounting body is also sort of coming more around to the way that we look at capitalizing some of these traditionally expensed items. Some of the other items that we adjust, reported retirement expense less service cost, the change in bookkeeping reserves for bad debts, LIFO to FIFO inventory adjustments, warranty expenses. The list does go on. I'm not going to go through each one, but again, I just wanted to highlight we are making these adjustments to come up with that apples to apples comparison. The third line on this chart is what we call capital intensity. The red line, think of that as the inverse of asset turns. So the maths behind it is dollar of capital divided by sales. This is pretty much the only line I'm going to show on the fundamental side where lower is better. So if the red line is going down, then the company is scaling into prior levels of investment. So think of that as asset efficiency improvement, right? So let's just conclude on those three three things I've gone through. So sales growth, that's simply the sales growth on a trailing 4-quarter basis. The EBITDA margin, that's our cleaned up P&L, true kind of profitability measure. And then the third one, capital intensity, that's the asset efficiency measure. So you can see for this company that actually from that 2010 period to 2020, so a decade-long period of all three EVA drivers going the right way. So we saw really strong sales growth, so sales growth of what's that, probably about 6-7% persistent sales growth on a trading 4-quarter basis. We saw EBITDA margin go from probably around sort of 12%, 11% up to more like 18%. So like a 600 basis point expansion to profitability, and also a significant decline, so improvement in the asset efficiency. So we congratulate management in pulling all three of those levers, driving really strong EVA drivers, which if we go forward to the next slide, we'll see what that means from a pulling that together in the EVA fundamental picture. So as I said a couple of slides ago, EVA margin is our profitability indicator. So that red line represents the level of economic profitability. We know it's fully loaded for capital invested in the business and after correcting accounting distortions. So if that red line's above 0, we can say the firm is covering above its cost of capital. It's an economically viable business. The blue line on this chart is what we call EVA momentum. So that's a change in EVA divided by that sales in the prior period. It's an EVA growth measure. So as long as the EVA momentum is positive, then we're compounding growth and creating new incremental EVA. And I like to think of that as really a business model momentum. So if you think, again, what we saw with the EVA drivers, so those three EVA drivers moving in the right direction, and that's fed through to the EVA margin of seeing a great expansion story, going from single digit, a couple of percent EVA margin, all the way up to over 10%, right? So an 800 basis point improvement in EVA profitability. So it's a really, really strong compounding story. And you can see that EVA momentum during that same period remained positive. So continue to see that incremental value creation story. The blue shaded area is the absolute stock performance. So you can see for this stock, it's actually been very well rewarded as a shareholder as well during that large expansion in economic profitability. We also then think about EVA shock. So that's the last bullet point here. And EVA shock represents a change in direction of EVA momentum. And it's really important in terms of understanding if something is accelerating or decelerating. And we really use this a lot for investment timing. So particularly looking for a positive inflection. And you can see that positive inflection a couple of points on this slide. So when EVA momentum starts to decelerate, but then you see a positive upkick. So just before the 2015 period, around the COVID period, and then again sort of through 2024, we saw a bottoming. This was interesting because it was actually EVA momentum had turned negative, so we're seeing incremental value destruction, but actually we would have been starting to become positive because we started to see an improvement coming through. So becoming less negative during that period. You'll notice also there's a couple of forward-looking lines on this chart. And the first of them is the solid red and the solid blue line. And the solid red line is representing consensus. So all we do here is take the IBIS consensus, we still care about the EVA adjustment, so we make those cleaned up EVA adjustments to the consensus number, but it means that you as the investor can kind of see what the outlook from the traditional sell side is suggesting. So for this stock, actually, the consensus is not particularly optimistic. The consensus is basically saying we see kind of flat growth over the next couple of years with a slight uptick in the latter years. So that's one way of thinking about the future. We also think about the future from a market implied margin perspective. So that looking at that crosshair, so that red crosshair, you can see that that's the 5-year window of EVA required to back out to today's share price. So those aware of a DCF model, what we're doing is similar kind of maths. Instead of using the free cash flow, we're using the EVA required to, as I said, back out today's current share price. So that gives a reflection if the market's bullish or bearish about future value creation. So I said consensus is not particularly that optimistic, but actually the market's much more optimistic about the outlook for value creation. And actually over the next few years, seeing the EVA margin going back to back and above the previous record levels. So the market's much more optimistic about the future than consensus. We go to the next slide. We'll then build upon that kind of investor expectation story by looking at our first one. It can look a little bit daunting, that bar chart on the left, but let's break it down. So first of all, what we're doing with this chart is looking at the enterprise value. So we're looking at capital, which is including all capital invested in the business. So that's working capital, net PP&E, property, plant and equipment, add and promotion, present value of rents, intangible capital, etc. So if you think of the blue bars as what you own as the investor, we then think about the earnings story. So when looking at those red bars, current value added, which is taking today's dollar of EVA divided by the cost of capital, that is assuming, and I should also say assuming no growth in perpetuity. So basically that's what you've earned as the investor off of your capital base, right? So the blue is what you own, the red is what you've earned. We then model in the orange line, which is the market value. The market value is a given, and what we say is the red and the blue added together is actually the franchise value of a business. We know the market doesn't work off of pricing off of a franchise value. The market cares about the future. So then what we do is model in the gap between that franchise value and the market value, coming up with those gray bars, which we call future value added. And all that's reflecting is the amount of future value creation or destruction embedded in today's share price. So again, how bullish or bearish the market is on the outlook for value creation. So for this stock, it's really interesting that you had that massive wealth creation story we saw up until sort of 2021, and then we saw a period of value destruction, those red bars getting smaller. You did actually see the blue, the capital base expanding at the same time. So clearly this company was investing quite heavily, expanding its capital base. And now we look like the red bars are starting to stabilize. We saw that with EVA momentum kind of stabilizing. And the market turned from being bearish, so those gray bars being negative around sort of the 2021 to 2022 period, to now flipping back to being positive on the outlook for value creation. So the market's now basically expecting those red bars to start expanding again. And we saw that with the EVA margin level expected to increase over the next few years. These are all in dollar terms. We know them, again, the market doesn't think about valuations in dollar terms. So then what we do is use our future growth reliance chart. So that's the chart on the right, which is FGR, future growth reliance. pretty much everyone's going to be aware of PE charts, so price to earnings charts. This is kind of our PE equivalent. And all it's doing is looking at the percent of today's share price that's dependent on that growth coming through in the future. So that EVA growth coming through in the future. It puts a company's premium or discount into perspective. And you can see for this stock that the premium expanded to above 25%. So 25% plus of today's market value dependent on that growth coming forward. That's quite high. So you would look at this chart the same way as you'd say this stock's trading in a, let's say it traded between 12 and 20 times PE. We'd say this stock traditionally, the upper end trades sort of around 23%. So at 25% plus, it means that there's a hefty premium for that value creation story built into the current market value. So we'd be a little bit wary. So we looked at the fundamentals. The fundamentals are saying things look like they're bottoming out. That's great. We want to be buying into that improving story. But equally, we've got to be cognizant of what's already factored in by the market. And we'd be looking at this and saying, well, the market's moved ahead of this recovery story, and maybe that FGR is just looking a little bit too rich at this point. So we'd probably suggest looking at a buying opportunity when FGR comes back a little bit further for this. So that's kind of the fundamental and the valuation picture combined. And now I'm going to hand over to Casey, who's going to run you through the next 5 slides, looking at what we call the Prove It framework.
Gavin, I don't know if anyone else can hear you, but I lost you.
We're doing fine, Casey. Just you pick it up from there.
Okay. Prove It takes into account the profitability and valuation metrics that Gavin just went through. So Prove It is profitability, the P, the R, and the V are profitability, risk, and valuation. We've got the main scoring box here on the left, which shows Prove It scores versus different universes. So we're going to look at sort of Prove It versus the industry group of the company. We've got Prove It versus the country. So if you're just a U.S. investor, you can just look at a Prove It score versus other U.S. companies. And then we've got a Prove It Prime, which actually regresses out some biases that we see for sectors and for different countries, countries that maybe always have a higher Prove It score just because of sort of structural advantages or disadvantages that they might have. The heat map you'll see in almost all of our research. This heat map on the right shows quality on the y-axis. So that's that profitability. It's a risk-adjusted profitability. The higher the better. On the x-axis, you have valuation, and this is actually plotted in reverse because a high valuation, a score of 100 for your valuation is expensive, and as you go to the right, you get cheaper and cheaper. So here's Home Depot, which is actually the fundamentals that we were showing. These are old data points, but Home Depot at the time was a relatively sort of above the median in terms of producing quality, in producing EVA, high EVA margin, but it's also listed as pretty expensive. So it's more expensive than about 88% of the market, but it's producing a risk-adjusted profitability that's only around the 64th percent. So overall, that's going to give you a lower Prove It score. Prove It is score from 0, which is least attractive, to 100, which would be the most attractive. Those would be companies up here where they have really high quality and are really cheap. This breaks down the different components of the Prove It score. So again, profitability, risk, and valuation. as Gavin went through what the EVA margin is. We saw that on the line graphs. We also look at EVA to capital. We call it EVA spread. So this will show you what Home Depot's numbers are, what the industry or country percentages are, so 25th, 50th, 75th percentile, and then how that actually scores. In this case, we're using the industry. So Home Depot would be better than 86% of the industry for EVA margin. The growth, that EVA momentum, is also part of our
Gavin, we've lost your audio. Sorry, Casey, we've lost your audio.
Can you hear me okay though, Andrew? Yeah?
I can hear you now, Gavin, but Casey, you've just suddenly dropped off there. Looks like he's going to have to call back in. So there we go, Casey, you're back. We lost you there for about 30 seconds.
Oh, I'm sorry. So profitability level. P1 is how profitable the company is. The profitability trend, the P2 factor, is where they're growing. So if you go back to what Gavin was talking about, the red line is the level, the EVA margin is the level of profitability, and then the EVA momentum was coming down. That means that their growth is coming down, and that's why this company has a relatively low profitability trend score. Risk, our risk factor has volatility, which is the volatility of stock price, also the volatility of the EVA margin. So how much is their profitability bouncing around? And then we've got vulnerability as our second risk factor or sub-factor. That looks at free cash flow, it looks at leverage, debt to capital, etc. And then finally, the valuation metrics come up with a valuation score. We've got sort of our cleaned up price to book, price to sales, price to book, and then the future growth reliance that Gavin just talked about, how much of the value is coming from future growth. Again, so we've got P, R, and V, prove it. Over time, so on a monthly basis, we generate reports like this for the global region, global large cap, global small cap, US, Europe, and Asia. We look at the spreads. So obviously we're looking at the top quintile versus the bottom quintile. That's the spread. And again, we produce these every month, as you can see. All of the factors prove it, and all of the factors have generated good alpha over time. Everything here is equal weighted. We produce graphs like this that show, what kind of a market are we in. Prove it in the dark blue line. Quality is the light blue line. Value is the green line. So here from 2015 to 2020, value didn't work. So expensive stocks got more expensive, cheap stocks got cheaper. At the same time, we had a little period where a little dip where quality didn't work, but then quality has picked up. Value has been picked up since a couple months into COVID. We had a real cheap value run. So this just gives you a sense of where we are, what the current market conditions are. And again, these are included in our monthly reports, and we do it by market cap and we do it by regions. And this brings us back to the heat map that we talked about earlier. We break it into different zones. As I mentioned, your highest prove it scores are going to be up here. These are companies that have the highest quality but are not getting rewarded in the market, so they have the cheapest valuations. As you move over here, this expensive but worth it zone. These are high quality companies, but the market has recognized that they're high quality. They're definitely more expensive than the best of the best, but we still think that the trade-off is worth it, so they remain attractive. The flip side to the expensive but worth it is the overly expensive quality. These are going to be companies with similar quality scores, but the valuations have tipped, and now they are no longer attractive in the prove it model. As Gavin had mentioned, we are style agnostic, so we also have attractive names down here that are low quality firms that are cheap. So these can also have high prove it scores. Again, they are the attractive value is cheap, but they're cheap enough to justify the low quality that the companies are producing. The value traps are companies that are cheap, low quality, but are not cheap enough to justify the low quality. And then, of course, we have the worst of the worst, which are companies that are very expensive and have really no fundamental basis. They have very poor quality, low profitability. You'll find early stage biotech companies here, smaller cap technology companies where they're trading on news flow. They're trading on, they have really high expectations. Their future growth reliance is very high, and the fundamentals haven't kicked in yet, right? They haven't actually created any value. We use the heat map and the zones in probably 80% of our reports. And with that, I'll turn it back to Gavin if he can be heard to go through some of our weekly research.
Yep, thank you, Casey, and hopefully everyone can hear me. So we're going to run through the next few slides looking at the different form of research content available on the ibkr platform. And this one starts with the company snapshot report, which are updated each time we have a recommendation change. So as I said earlier, we covered 29,000 companies, and all 29,000 companies will have a company snapshot report produced at the time of a recommendation change. So really good coverage. And this is a really sort of good 3-page report to get a good idea, sort of using the charts that I showed earlier, so the EVA fundamentals chart, the EVA drivers chart, along with the prove it heat map. So as Casey just highlighted, you can kind of see where the firm is living relative to the market, or in this case, relative to the industry. So this firm will be living in that upper left, what we call expensive but worth it. And then you'll see on the bottom half of this first page that you have a strong points and red flags. So looking at those strengths and weaknesses, and that's broken down in looking at growth and profitability, cash margin and capital turns, performance drivers, and finally valuation and market expectations. So it's giving a good insight in terms of some of those areas that you should be considering if looking at making an investment in that particular company. On the right, you'll see the prove it component. So cases run through sort of the profitability, risk, valuation scores. And then on the second page, so going on to the right hand side, you'll see what we call the EVA income statement. So that's showing up a lot of our cleaned up P&L measures. You can see the separate line items for COGS and SG&A, so cost of goods sold, sales, general administrative costs. You can see what's driving that EBITDA margin change, and then you'll see some of the EVA levels and EVA margin towards the bottom of the P&L. So it gives a good transparency in terms of the as report or the historical numbers, but also thinking about the consensus numbers as well. And then that bottom right is bringing in the enterprise value chart, which I ran through, and that future growth reliance chart as well. And if you page forward, Casey, you'll see the last page of the company snapshot report, which then looks at the historical recommendations. So on the right, you'll see how this stock has been rated over over a long period of time, and also additional data points around profitability, risk, and valuation. Okay, next slide. Introducing the next type of report we call industry snapshots. So these are really good, high-level, digestible snapshot 3-page reports to look at an industry. So if you want to look, in this case, it's the global broadline retail industry. We start off with those EVA fundamental charts going into then the valuation charts. And then what we do is list out the top 10 largest firms by market cap in that industry to give a reflection in terms of, from a market cap perspective, what's driving that industry. And then the second 10 stocks, that bottom table, is showing from a prove it perspective, so from that risk adjusted profitability versus valuation perspective, which firms look interesting. And that can be, as in this case, you can see some of the large cap names have made it through to the top 10 list, but you'll see there's a lot of sort of more mid cap names that also come through that list. So the snapshots, as I said, a good way to approach an industry and quickly understand, as I said, kind of where the exposure is, what's the underlying fundamentals for that industry. The next one is what we call the stock screen report. So if you page forward, yeah, stock screen reports. So this particular report was called Expensive or Cheap, shopping for stock picks in the developed markets. Excuse me. And we run different types of screen reports. They might, as Casey showed, breaking down that heat map, we might run an expensive but worth it kind of screen, or a high quality and cheap particular screen one week, and sort of thinking about where the market direction is at a given time, and what kind of stocks we think meet that specific theme or criteria within the stock picking. Then the next one we call names in the news. So this is the more bottom up 2 stock analysis report. So generally what we're doing is looking at a couple of firms that have been in the news over the past week, and then we run through the analysis looking at that firm or those 2 firms through the EVA lens. And again, it's really insightful in terms of how the stocks are looking. And I would say all of these reports are always very educational as well. So even if you wasn't at the time looking at ASML or EasyJet in this case on this report, you can still follow the thought process. It's kind of mechanical sort of framework process that we use to analyze the stock. So you could use this as education material as well. But generally, as I said, kind of the stocks are quite topical at that time, so should be of a relevant interest. Then the next report is more of a top-down style report. So this is called, this particular report was Developed Market Industrials. So looking at European beneficiaries at the expense of the US. So earlier in the year, obviously as capital was coming out of US markets, we were getting a lot of inquiries from clients looking at European opportunities within the industrial space. So not just within the aerospace and defense industry, but also sort of thinking across the board within industrials, where to potentially look to get exposure across Europe, but also equally which US names had maybe come back a little bit, which were beginning to look a bit more attractive from a valuation perspective, given the pullback we saw earlier in the year with the US market. Okay, then the next report is sort of what we call our macro reports. So again, sort of the top-down style of reports. This one in particular was looking at Japanese equities. So as the tariff talks earlier in over the past couple of months had been kicking off, we actually identified Japan as a potential beneficiary. So we were thinking about sort of the tariff talks being a pivotal time when Japan also was looking at EV momentum just starting to trade around the 0% mark, right? So, and you can see the consensus line was actually suggesting that momentum continued to improve and actually turn positive through this year into next. So we thought it was quite topical. Both you've got sort of Japan that potentially was in a better place with the tariff negotiations, plus also the fundamental picture looking reasonably solid for Japan. And then the last type of reports, which Casey has alluded to when he was covering some more of the sort of the factor back testing. We have two sort of quant style reports. We have what's called our Prove It Factor Monthly, and this one's global, but we cover each of the different regions. These are produced pretty much the first week of each new month, and they're a good look back, but also have a good you see that figure 30 and 31 looking at kind of where valuations are across the different sectors, so you can see what's looking expensive, what's looking a little bit cheaper at that stage. And then the last report or style of report on the next slide is the weekly quant corner. So this is looking at month to date, kind of what factors are working. And you can see that this was towards the end of May, and you can see that Prove It spreads by region, quite a big diversity there, with the US seeing negative Prove It, whereas Europe was seeing a big positive Prove It, and that was really being driven by those quality spreads. So seeing a strong quality move in Europe, and sort of quality selling off initially through May in the US. So it's a really sort of timely, good sort of weekly check-in to see what factors are working at a given time. Okay, that's all we'd prepared today. So we really sort of thank you for your time and interest. I think we have time for Q&A, so I'll hand back to Andrew for that.
Brilliant. Thank you very much, Gavin and Casey. Alex asks, points out that this can be used for analyzing individual stocks, but can it also be used to analyze a stock portfolio?
So not with the not through the ibkr platform, but please do reach out to us individually. You'll see on this slide you've got the email address, and we can run the portfolio analysis using our dedicated platform. So please do reach out if you have interest there.
Okay, Ali asks, can the EVA framework be used to evaluate newly listed companies with limited financial history? That's a good question.
Yeah, it's a great question. Normally, we will add an IPO certainly if it's a large new issuance within a couple of months, if not sooner, within the platform. So that means that a stock report will get generated for it. It does sort of normally when firms are listing, then we will have at least a year of data. So clearly we won't have the same history as we would for a firm that's been around for a number of years, but we will have those EVA drivers, EVA fundamentals, EV chart, and valuation charts for the time period that we have information for.
Do you want to talk about a little bit about Luis Gustavo asks a question about the price of the reports and the package that's available. Could you just go over again, please, Gavin, what's available through the ibkr platform?
Yeah, definitely. So the research reports that I ran through, so those last few slides, Casey, do you just want to do a quick rewind on them. So the quant reports, they're available. So both the monthly and the quant corner, the industry snapshot reports, the stock, the company snapshots for that 29,000 companies, the stock screen reports, the names in the news. So all of those research reports that I ran through towards the end of the presentation are all available on the research ibkr platform. So yeah.
Now, is that at a cost, or is that?
No, that's all available.
All of that's okay. So those reports have been licensed to Interactive Brokers,
correct,
to disseminate to the clients. So Louis Gustavo, they're all available there for free on the platform.
Yeah. So please do read.
Go ahead, Gavin.
So I said, please do read them. They're there for your disposal.
Yeah, and Gavin sends me an email every week with an overview, and we post that to our Traders Insight page on the website, which filters through into all of our platforms. So do keep a lookout for that, and you might see that in your email every week as well. All right, I think that's all of the questions from today's session. Thank you very much for showing up today, Gavin and Casey.
Thank you so much for hosting it, Andrew.
Yeah, thank you.
All right, and the recording of today's event will be available on the Interactive Brokers website. We'll send you an email if you're registered. It's available under the webinar recordings, or the previously recorded webinars at the campus under webinars. As I say, content is available on Traders Insight and also inside the client portal, Trader Workstation, mobile devices. Have a look under Analyst Research and you'll find a link to ISS EVA. And if you act quickly, you'll be able to get the copy of the handouts here in the GoToWebinar panel. Expand the handout section and click on that PDF link. And this will also, this presentation will also be available on the ibkr website later on this afternoon. So there you go. That's everything. Thank you very much for joining me today, and we'll speak to you in the coming days. Thanks, everybody. Bye for now.
Thank you, everyone. Bye-bye.
Thanks.